Welcome to Money Sense. Adam Butler, Chief Investment Officer at Resolve Asset Management, hosting today on behalf of the CFA Society. My guest is my business partner and BNN TV regular, Michael Philbrick. And so, Mike, welcome. Yeah. I'm not sure if we can hear you, Mike.
Is it okay?
Yeah. Okay. Yep. Perfect. Oh, yep. Now we're good. So we were talking earlier about the fact that this is kind of like the duck on the surface of a pond market, right? There's seems like things are relatively calm. You've got major markets still near all-time highs. Yep. They've been sort of treading water a little bit for the last few weeks, maybe a couple months, but still no major causes for concern. And we thought today we'd try to broaden out the perspective because there's a lot going on beneath the surface. The duck's really paddling, right? Yep. And Mike was just on Bloomberg TV a couple days ago, and I thought it would be useful to share some of the perspectives that he shared with his audience there. So, Mike, what is not on people's radar, but that's really interesting happening at the moment?
Yeah, I think there's a few things. One is this what's called an inverted yield curve, where short-term interest rates are higher than longer-term interest rates, which is unusual. Normally, if you're looking at interest rate of 1 year, it's going to be lower in an interest rate than at 10 years. And we have that inverted where 2-year rates are kind of the highest across the board. And that has been persistent for over 550 some days now, which is a very long period of time. And it's long enough where it's sort of falling off the radar of a lot of, I think, financial analysts' radar screen. And if you look back in time, now we don't have a lot of sample size here, number of recessions, but the longer the inversion of a yield curve, generally the worse the recession. So at this point, this long of a yield curve inversion, that is shorter rates higher than longer term rates, is longer than any other recorded in history. And the other two that are in the same range are the recession of 2008 and the recession of 1929. So that's not a great look. Mm-hmm. And at the same time, it's not unusual for markets to be making these kind of all-time highs at the same time as the inversion is happening. 2008 saw that, 1928 leading into 1929 saw that. So really the scene is set, and while the music, I guess, is playing and markets are making all-time highs and things are doing well, and participants are forced to play along. And I think the other thing that's become, persistently obvious is, as we've talked to advisors and investors in our business, is that there's kind of a lack of feel of need to diversify or to make sure that there are hedges in the portfolio or to make sure the portfolio is balanced against things like energy shocks.
Well, right? They've been, when you think about it, you can sort of forgive advisors and forgive investors for being sanguine about diversification, because over the last 10 or 12 years, it hasn't really paid to diversify away from U.S. equities for the most part.
Precisely.
And right when we thought the diversification was going to pay off, and it did for a time, obviously in 2022, it paid handsomely to be diversified. But since then, we've gone right back to all-time highs. The tech leadership has persisted. And I think so, you can be forgiven for, but there are, as we talked about, there's lots going on under the surface that maybe investors might want to pay more attention to now than they have in the past.
Right. So this complacency is definitely forgivable. Diversification has been an albatross. But again, that road kind of turns and comes around the other way. If you do look under the surface of the markets and look to other markets other than U.S. equities, you do see performance that is competitive or superior to the U.S., and nobody's looking at it. I remember us talking about Japan a year ago, being long Japan stocks and short the yen, which are a number of ETFs that do that for you at a very low cost. That particular type of trade is, up 40 to 50% over the last year, which is significantly better than U.S. stocks.
And what's amazing, too, about Japan, just to reiterate, because I still find most people don't realize this, but the Japanese stock market peaked in 1989. Yep. 1989. It went down 75%. and stayed there, just sort of crawling along the bottom of the trough for decades.
Yeah.
And has only reached new all-time highs in nominal terms in this calendar year.
Correct.
So it's remarkable and something to pay attention to.
Agreed. And so you've got this opportunity for international diversification across countries and business cycles that are different, that are based in different sort of regimes. So if you think about the emerging markets, you think about more resource-based economies, they have been doing well. Argentina, Latin America, again, very nicely performing markets that are lovely diversifiers to your geographical focus on the U.S.
And even within the U.S. index itself, people think they're diversified because they own the broad index, but
Right.
the index has actually become very concentrated. It really is kind of just one trade at the moment, and there's some really important sectors that will matter to the economy that are being vastly underpriced.
Absolutely. So if you think back through all of the recessions we've had, and we've talked about this inverted yield curve. So there's a set of conditions that is opportune for a shock to have really negative implications, right? It's that old story of the pile of sand, and eventually that one grain of sand hits the pile of sand, and then there's a sort of this cataclysmic cascade of events. And so we're at a critical state at the moment where if you think about energy prices, so energy prices have led to recessions in a place where you have an inverted yield curve. 2008, people forget that it was an oil shock, oil to $143 a barrel, that eventually was the straw that broke the camel's back. And the 70s saw that multiple times. So could we see an energy shock here that then conveys into a recession? Sure, $10 in oil equals, sort of 30 to 40 basis points off of global GDP. So then you say, well, why does that matter, Mike? Well, if you're in the S&P 500, the largest, most widely followed index in the world that has, garnered the vast majority of global money, only 4% of that is exposed to the energy sector versus, it being sort of 16% back in 2007 and 8. Conversely, in 2020, it bottomed at 2%. But if we have an energy shock, there really isn't much in your portfolio in the S&P 500 context to hedge you from that.
I mean, the reality is even those energy shares, unless oil stays persistently high, most of the energy companies sell most of their production forward for years at a time, right? And so even owning energy stocks, and we've seen this in gold as well. We've got gold breaking out to brand new highs. I think you mentioned to me in the car, reminding me that gold has now outperformed the S&P over the last 1 and 3 years and is competitive with global stocks over the last 30 and 40 years. But gold stocks have not kept up at all. And part of the reason is that while the price is rising, many of them have sold much of that gold forward at lower prices. And their cost of mining the gold has also risen substantially.
Correct.
So their profits have not risen commensurate with the price of gold.
Which is a really interesting scenario, right? Because we have been in this sort of disinflationary regime for quite some period of time. And I wonder whether that doesn't flip, because you can't actually produce gold for the price it sells for now. In the current construct of in trying to build a mine and all the costs associated with that and all the things you have to do to get that approved. So there's potentially, while gold stocks have had a 0% return over the same period where gold has been competitive with U.S. stocks, one wonders if that flips, because you can't get gold out of the ground for that price. And so when the gold stocks get pricing power back, they potentially could have immense leverage to the gold price. That has not been the case for the last 20 or 30 years, but that's the kind of scenario where the table gets set where everyone says, you can't make money in gold stocks, just buy gold. I'm like, maybe this is the next 20 years, is the pricing power coming back to gold where they get a profit margin because gold is in such demand, because we've got, sort of this fiat currency being undercut constantly and being diluted by the fiscal largesse of the global
and we
governments.
should talk about why gold may be rising. But also I'm reminded of one of my favorite expressions from Don Cox, the chief
Yep.
strategist at BMO Harris way back in the day, who used to say the best opportunities in commodities are when those who know it best love it least because they've been disappointed most. And
Nailed it.
you know, these commodity producers are just used to selling their production forward because they're used to, you know, being disappointed. The price of their what they're producing has tended to fall, and because we've been in this sort of disinflationary environment. But you know, 2022 reminded us that these disinflationary times don't last forever, right? And so what do we think is driving this recent surge in gold?
Well, what's interesting is the exchange-traded products in gold over the last 2 years have all suffered declines in the assets under administration. So the amount of money that's been in the actual ETFs, the number of shares, has been declining. So that means that institutions and individual investors have been general sellers, yet we have new all-time highs in gold. Well, who is the buyer? And I think we talked about this with Doomberg on our Resolve Riffs podcast. The price of gold in London was significantly cheaper than the price of gold in Shanghai. And so gold was being bought in London and sold in Shanghai. So gold is moving from the west to the east. Part of the driver for that is, the confiscation of assets, of Russian assets by G7 for the invasion of Ukraine, which was a tremendous change in tenor globally. Like, Russia is part of the UN. And so then we've got, on the flip side of that, some of that money being rewarded to Ukraine to fight Russia. Now think about that. If you're a country holding U.S. treasuries as a core asset, and you're worried you might do something that the G7 or the United States doesn't like, and they just might confiscate your money. Well, what other asset can you own and have some sovereign rights on that asset? Well, physical gold is that. That's why, Shanghai gold was priced higher, and literally the physical gold has been moving from, Western vaults to Eastern vaults. And so that's who's the buyer on the other side of the exchange traded funds being sellers, and that's institutions and retail, because institutions don't generally hold physical gold either. So this is a very interesting opportunistic trade, in my opinion, when you look at gold as an asset class. First of all, it's a very orthogonal asset class. It preserves purchasing power, 5,000 years of history. So it's a very different asset class. Mm-hmm. It doesn't have cash flow, right? So that's another kind of weird thing with this asset class. But being such a unique asset class and being able to add such diversifying qualities to a portfolio and having outperformed and nobody interested, these are things where I'm like, well, sign me up.
Absolutely. So, when we come back after our break, we'll probably continue to sort of close the loop on gold, and there's some news in the yen and the U.S.'s relationship with the yen and a variety of other factors.
AI, we've got to talk about that.
We'll talk about AI, yeah.
Radio Cayman, maintaining the innovation.
On a daily basis, making it easy to connect with you, our listeners. Add us to WhatsApp today, 925-3261. That's 925-3261.
Radio Cayman.
Send a text or voice note.
Message us at 925-3261 on WhatsApp today and get active with Radio Cayman.
Radio Cayman, the voice of the Cayman Islands.
Radio Cayman, maintaining the innovation.
This is
Money Sense, bringing an informed financial perspective to the Cayman community. Brought to you by the CFA Society Cayman Islands.
And now, more Money Sense.
All right. Welcome back to Money Sense. This is Adam Butler, Chief Investment Officer at Resolve Asset Management. I'm here with Michael Philbrick, my business partner and BNN TV regular. And we were just jamming about what is happening in global currency markets and how global central banks are diversifying their exposure to the U.S. dollar and U.S. dollar assets and why they're doing that. So maybe we'll sort of recap that, and then we're going to go on to some of the other moves that are happening that are really important to how things might unfold.
Right. So we've got a number of different material-based, things that if you drop on your foot, they hurt. and those things are breaking out to new highs. While institutionally, or we're not seeing it in market caps, which is exciting. And then we have on the on the yen side, right? We've got this carry trade. Maybe I think I'll throw this over to you. So we've had a breakdown in the yen, and this is one of the things from my perspective I look at is what is the straw that breaks the camel's back, whether it's energy or something related to the yen that causes central banks of the world to have to act in ways that might not be particularly conducive for their base of electorate. So, in the U.S., you've got the potential for inflation. At the same time, if we have something go wrong in the yen, maybe the U.S. would have to cut rates and cause inflation to run rampant in their home country, losing votes and things like that. But you're better at the currency transactions than me, and maybe you can walk us down the yen path a little bit.
What really struck me in the past couple of weeks is, as you've said, the yen has been steadily crashing against other global currencies, especially the U.S. dollar, and it hit a critical point 2 Sundays ago, this 160 yen to the dollar range. And this is important because the Japan and China and the whole Asian rim have what's called a mercantilist economic model. So their economies are based on manufacturing things that they export to the world. And in return for exporting those things to the world, they import a lot of dollars, and they typically buy treasury bills with those dollars or treasury bonds with those dollars. And that is the source of their sovereign wealth, their reserves. And what happened in the last week or so is that the Bank of Japan and their Ministry of Finance, which is the entity that actually owns all of the dollar assets on behalf of the Japanese people, they decided that this 160 level, they didn't want to go beyond that. And there's probably a number of reasons for that. It actually is nicely beneficial to the Japanese economy for the yen to be weak because it makes their exports more competitive. But by the same token, it's a hostile maneuver by Japan against other mercantilist countries and could trigger a devaluation by China and Vietnam and Indonesia and Philippines and all of these other mercantilist nations. And so they stepped in and with the U.S.'s help, because this is critical. How does a country defend its own currency? Well, they need to sell U.S. dollar reserves in order to buy yen, okay? So they've got all these U.S. dollar reserves in the form of U.S. Treasury bonds, but the Fed is very actively managing interest rates. So if the Ministry of Finance of Japan were to step in and sell billions of dollars of Treasury bonds, just sort of float that into the market, it means that Treasury bond prices at the margin go lower, which means that interest rates go higher. So it's this sort of vicious cycle with the Bank of Japan. So the Fed said, well, we don't want disorderly liquidation of Japan's treasury reserves, so we will give them access to basically unlimited swap lines, which basically says the U.S. Fed will create new dollars to loan to the Ministry of Finance and the Bank of Japan so that they can use those dollars to buy yen, to support the yen, and they don't need to sell those treasury bonds, which I said is setting the stage for maybe another sort of Bretton Woods type agreement among the global major economies. So maybe we can go into a little bit about what Bretton Woods was in a very basic way in the 1970s and how it's sort of shaping up similarly.
Well, that is what is Bretton Woods 3 now. It will be.
Yeah, right.
So, what my history lessons on Bretton Woods was is escaping me at the moment. That was the agreement between the various countries of the world on what the currency relationships would be. I think the first one was based on gold, though, right?
Yeah. So they all decided they were going to devalue the value of their currencies together, peg them relative to gold. And then there was another agreement that said we're going to float the currencies and we're no longer going to use gold as our reserve asset. And So it seems like with all of the currency devaluations that are happening around the world, I mean, the world cannot go on as normal with the yen so weak without other countries needing to devalue in order to remain competitive, right? And so it's this sort of cascade of global devaluations that also is probably motivating some of these flows into gold, right?
Right. Yeah, absolutely. And if you think back to, that 1998 experience with the Thai baht leading into a Russian ruble collapse at long-term capital management. And then again, that was one of those tricky spots where the central bank of the United States had to reduce interest rates in order to, manage that situation in an orderly fashion, which then took the NASDAQ from 2,000 to 5,000.
Right. Yeah.
Right. So massive liquidity goes into the system, and then you get these kind of bubbles that pop up everywhere.
Well, that's the
there's so
right
much
tail
liquidity.
risk that you've
Correct.
been talking a lot about. So maybe just sort of go into what does that mean? What is right tail risk?
Right.
And what are other ways that right tail risk might manifest? And then how can investors maybe be more successful in defending
Right.
against that
And
risk?
so the right tail risk is, as we talked about earlier, diversification has been an albatross, right? So if you have your portfolio of stocks and bonds and you take some away to have something that's a different asset that diversifies, often that tracking error leaves you with lower returns to the benchmark that you might be behaviorally
Right. So
beholden
you've got
to.
your portfolio in, let's say, the common kind of 60% stocks, 40% bonds. You decide, I'm a little worried about inflation here. I know that stocks and bonds both react poorly to stronger than expected inflation. So I'm going to sell down some of my stocks and bonds in order to make room for some other assets.
Right.
Maybe to buy some gold or buy some commodities or buy some inflation protected securities,
Managed
that sort of
futures
thing.
portfolios.
Managed futures. But then I'm fearful because I've had to reduce my exposure to the things that have treated me so well.
Yeah.
So is there another way to protect against this route tail risk without having to sell down your core assets?
So diversification via subtraction is what you've talked about.
Right.
Right. So you've got to take some away of the betas, the stocks and bonds you know, love, and trust. Rather than doing that, we've come up with a concept called return stacking and return stacked portfolios, which says rather than giving those up, do diversification by addition, so that you simply stack on top of the diversifier, so you maintain your exposure to the stocks and bonds you love so much. And if you get into a situation where there's an event, a critical event that creates the opportunity for more money to be printed and asset prices to rise more, that's the right tail risk. When things do really, really well and you're left out for some of them, doing it with a return stacked portfolio leaves you with your diversifiers, but also participating in the stocks and bonds that you know, love, and trust so well.
Yeah, it's a tricky situation, right? Because people are very comfortable with their equities and their bonds. Maybe they're buying them through ETFs or mutual funds, which is all great.
Low cost.
But as we discussed, there really aren't very many reliable diversifiers against right tail risk in your stock and bond portfolio. The energy and materials sectors in the portfolio, which are the sort of better inflation hedges, represent negligible proportions of equity indices at the moment. And even if they were more representative in indices, there's no guarantee that the margins on their products are going to increase faster than their cost of production, and therefore they may not actually act as the hedge you want, which means you really should have, or be thinking about at least, having some exposure to the actual underlying commodities themselves. And it's, sometimes not very obvious how to do that.
Right. And so that's where we sit a lot of times, is in the managed future space, where we do look at energy as a sector, everything from natural gas to heating oil to your typical West Texas intermediate crude and things like that. And those are those real energy inputs. And if you think about, you're managing a portfolio, you would like that portfolio to grow, offset your cost of livings, and fund your lifestyle. If you're just in stocks and bonds, well, only 4% of the S&P is related to energy stocks. And as you say, we don't know if those profit margins are going to be are going to accrue in a way that we would expect. But if you have actual exposure to the underlying commodities themselves, copper and things like that, things if you drop on your foot, they hurt. then you do have hedges in your portfolio that will respond in ways to grow your portfolio in a year like 2022, where both stocks and bonds were falling.
Mm-hmm. Yeah, and we've seen also copper showing extremely strong moves here.
Very similar to that gold situation, where
Yeah.
not a lot of expansion in the AUM, but prices are at new highs.
Yeah.
So that's like, who's buying that? It's not the average investor.
Well, the
It's-
Chinese have a very clear industrial policy
Mm-hmm.
to massively expand electrification over
Yep.
the next 5 years. And I mean, they're converting the vast majority of their auto fleet to EV vehicles.
Yep.
And I mean, they're way ahead of where we are in the West. They had, the last 5 years, they spent building EV infrastructure in China and massively scaling the production
Yep.
of electrovoltaic cells. And so they're a global leader now to such an extent. They're producing so many solar cells so cheaply that the U.S., who's been, banging the drum on a need for a major shift to sustainable energy sources, is putting tariffs
Yeah.
on Chinese imports of solar panels. I mean, this is how absurd things have gotten.
Anti-free trade.
Yeah,
We're
right.
rolling back. The peace dividend is gone, and this reshoring is real.
Yeah.
And that causes more inflation. So, then you get into, okay, so we've got an inflationary environment. Now we're going to layer AI on top. Maybe that productivity brings down the inflation, but it also consumes so much more electricity. So you've got these data centers that are consuming massive amounts of electrons. A Google search an AI search is 17 times more energy intensive than a Google search. And a lot of AI is taking over that search function in the world today. So we're going to need more energy. That comes back to, well, how do you get more energy? You need more copper. You need more base metals. You need more stuff.
I need more coffee.
Yeah.
I thought before, speaking of AI, I thought before we left, we've only got a minute or so left, but just to mention that there were two major announcements this week too in the AI space. OpenAI, who is the progenitor of ChatGPT, which sort of was the global awakening of people's awareness about AI, have released a new model. They've now released their best model to the public for free. And it's amazing some of the use cases that people have already been putting to this. And it's, I'm sort of following on Twitter a little bit. And, I've been amazed over the last year at the fact that there was just so little attention being paid to these frontier models, like the GPT-4 model for OpenAI as an example. People just have been not interested in paying for the better models, which are so vastly superior than the free models. So now they've released the free models and it's blowing people's minds, right? And we're seeing this all the time. So I saw someone who was mostly blind, who had wired a camera to his glasses and was walking around a foreign city with the AI being able to see what was around him and guiding him, go right, go left, look out for the car.
Hail the cab.
Yeah, that's right. Hail the cab. A student working on an iPad where the AI can see what's on the screen, working through math problems with the AI, asking questions, guiding the students' thinking. The demonstration that OpenAI did with during their broadcast, where they had three people all talking in different languages and the AI translating between them in real time, was pretty mind-boggling. Saw somebody practicing in real time with GPT-4o for an interview.
Yeah.
And what's interesting about GPT-4o, which is the new state-of-the-art, free to everybody AI from OpenAI, is it can see video and it can, it has so many different capabilities. I encourage you all to go check it out.
Yeah. And this is like the internet. We have no idea what we're going to use this for too.
Yeah.
Like
So go experiment.
Yeah.
you're on the go, the experienced team at Foster's Pharmacy are here to help. Drop off your prescription while you shop or WhatsApp us and we'll prepare it, ready for your arrival.
Whether you need prescription or over-the-counter medications, blood glucose testing, or advice on vitamins and supplements, we're here early in the morning to late at night. Both of our locations at our Camana Bay and Airport stores are open 7 a.m. to 9